In 2008, while the global economy was collapsing, Warren Buffett had $37 billion in cash sitting in Berkshire Hathaway. He called it the worst position to be in. Not because he was losing money, because he wasn't making enough. The ultra-wealthy don't avoid cash because they're reckless. They avoid it because cash is a depreciating asset disguised as stability. And once you understand why, you'll never look at your savings account the same way. Most people treat cash like the safest thing they can own. It's liquid, it's stable, it's there when you need it. But here's what they don't tell you in financial literacy class: cash doesn't stay still, it rots. Inflation in the US averages around 3% per year. That means every year, your $100,000 in savings loses $3,000 in purchasing power. You didn't spend it, you didn't lose it, but it's worth less. After 10 years, that $100,000 only buys what $74 would have bought when you started. The rich understand something most people don't: holding. Cash isn't safe. It's a slow guaranteed loss. So where do they put their money? Not in a vault. Not in a checking account earning 0.01% interest. They put it into assets that generate cash flow or appreciate faster than inflation. Real estate, stocks, bonds, businesses, commodities. But here's the critical part most people miss: they don't just buy assets, they use leverage. When interest rates are low, the wealthy borrow against their assets instead of selling them. Let's say you're worth $50 million. You own $30 million in stocks. You need $2 million for a new investment. Normal person logic: sell $2 million in stock. Pay capital gains tax. Lose future appreciation. Wealthy person logic: borrow $2 million at 4% interest using your stock as collateral. Now you still own the $30 million in stock that's appreciating at 8% per year. You're paying 4% interest but gaining 8% growth. That's a 4% spread. That's free money. And you didn't pay $1 in taxes because you didn't sell anything. This is where it gets darker. The tax code is written to reward this behavior. If you sell stock, you pay capital gains tax 15% to 20% depending on your bracket. If you borrow against stock, you pay zero taxes. So the wealthiest people in the world structure their lives to never sell. They live off loans. Jeff Bezos, Elon Musk, Larry Ellison, they've all used this strategy. It's called buy, borrow, die. You buy assets. You borrow against them. You die with them. When you die, your heirs inherit those assets at a stepped-up basis, meaning the IRS resets the cost to current market value. No capital gains tax. Ever. Your heirs can sell immediately, tax-free, or keep borrowing against it forever. This is how generational wealth stays generational. Meanwhile, normal people are told to save for a rainy day. Build an emergency fund. Keep 6 months of expenses in cash. That advice isn't wrong, it's just incomplete. For someone living paycheck to paycheck, cash is a necessity. But for anyone with wealth, cash is a liability. Because while you're sitting on $100,000 earning 0.5% in a savings account, inflation is eroding it at 3%. And the wealthy are borrowing at 4%, investing at 10%, and paying zero taxes. The gap between the two strategies compounds exponentially. Over 30 years, $100,000 kept in cash becomes $40,000 in real purchasing power. The same $100,000 invested in the S&P 500 becomes $1.7 million. That's not a difference. That's a different universe. This isn't a conspiracy. It's just how the system is structured. The tax code rewards investment. It punishes saving. The Federal Reserve prints money, which dilutes cash but inflates asset prices. If you own assets, you win. If you hold cash, you lose. The rich figured this out decades ago. They don't have checking accounts with $10 million sitting idle. They have credit lines, margin accounts, and securities-backed loans. Their cash is always working, earning, compounding, leveraging. And when they need liquidity, they don't withdraw, they borrow. So no, the rich don't hold cash, not because they're smarter, because the rules are written for people who don't need to. And if you're still treating cash like safety, you're playing a game you were never supposed to win.